Joining me right now is Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli. Chris, good to see you. Thanks very much for being here. What's your take on the Fed meeting next week? Will that be a market mover?
I think the market's really expecting the Fed to raise interest rates by 75 basis points next week, and I think that's largely priced in. So I think what'll be much more important than necessarily the amount that they raise interest rates, but what they say in the press conference afterwards. If it looks like they're leaning towards another 75 basis points increase in December, I think that would be a slight surprise to the downside. But otherwise, I do think the market has mostly priced in the meeting for next week. So I'm not expecting a lot of surprises other than potentially a bias towards the upside in terms of a higher rate hike in December.
Well, we also have this tech sector selling off and really deepening. You've got Amazon shares skidding this morning on a weak sales outlook. The company talking about the holiday season perhaps not coming in as expected. What's your take on what we're seeing out of big tech and clear signs of a slowing economy?
That's exactly right. I mean, for the most part, big tech, which makes up a large part of both the S&P 500 index as well as the NASDAQ index, as you know, has all been pretty much disappointing with the exception of Apple. Apple's held in there pretty well, but Amazon, Facebook, Google, all of those companies have really had earnings that have missed expectations, and you've seen their share prices get hit pretty hard. Amazon is the most recent example of that. So I think that bodes poorly for the near future, at least in terms of tech. It seems like investors are turning away from tech, not necessarily believing that it's going to be as resilient through the next recession as people had previously hoped.
Yeah, but it's not just big tech, right? I mean, you're seeing demand destruction in housing as well. The 30-year mortgage rate is now exceeding 7%. First time we've seen that in 20 years. That's why you've got housing starts down and construction-related businesses down. What is your reaction to what's going on in housing? And is that going to be another pressure on folks with a 7.16% 30-year mortgage?
It absolutely will be. I mean, it's another sign of the economy starting to slow down, taking some hits. What's happening within the mortgage and housing market is a direct impact of the Fed raising interest rates. That's something that you're seeing relatively quickly. Other impacts of the Fed raising interest rates, I think, will take more time. But housing is a big part of the economy. It always has. Know through the great financial crisis, that's what led us on the way down. So housing is important. I think it is another sign of the economy starting to take some hits. None of these things bode well for the economy. The stock market is priced a lot of this in. I'd say the S&P 500 is already priced in a shallow recession. The NASDAQ is pricing in a more traditional recession. But we could have more downside over the next 3 to 6 months, depending on how things go with the economy. And right now, all signs are pointing in the wrong direction, unfortunately.
All right. Sounds like you want to raise cash, or are you stepping out? How are you allocating capital then, real quick?
So we've raised some cash, but for the most part, it's reallocation. We're going towards more safer sectors like healthcare, potentially consumer staples, while also maintaining our inflation hedges. So energy, commodities, materials, things that will help protect us if inflation remains sticky, as we think it probably will.